Thomas Friedberger joins us now, Deputy CEO of Co-CIO Capital. Thomas, it's great to have you with us this morning. Thank you for stopping in. I think has surprised some that the market has quickly forgotten the concerns of last week around credit, around private credit, around leverage loans. We're seeing markets back up at the highs this week. In your view, should we be worried about private credit?
Well, it depends. I mean, we shouldn't be worried about the fact that there are defaults because private credit, at least on the high yield part of private credit, is about structuring instruments that are risky. So having defaults is something which is normal. The way to manage default will make a big difference probably between asset managers in the generation of performance. We've seen, it's our experience that the recovery rate on those private credit, especially on the direct lending side, instruments can go from 0 to more than 100% of your principal. So it's more the way that asset managers handle with defaults and manage defaults and have the capacity, the platform to manage those defaults, which will count.
Will make the big difference.
Yes.
Last week, we saw both U.S. regional banks and the big lenders come under pressure in Europe as well, even though the concerns were centered in the U.S. as of last week. We had a guest on yesterday from Morningstar saying that provisioning is going to rise in Europe because right now the European banks are not provisioning for a significant uptick in defaults. How widespread do you think the concerns should be, or how widespread do you think the problem could be?
Well, right now, I mean, I don't see anything systemic. Okay. Those defaults are probably located in closed-end funds. So it's not 2008 like 2007, 2008 like scenario for the moment. We are still optimistic that with a good discipline and asset selection, you can generate performances, especially in Europe on the primary side of direct lending, in the US more on the secondary side of direct lending. But having your boots on the ground, being disciplined. Not making any concession on covenants, structuring covenants is paramount in navigating this cycle. It's true that spreads are tight, that the market has been aggressive recently. But again, it's also about alignment of interest. Alignment of interest is probably the only way long term to manage to remain disciplined in this environment.
When it comes to discipline, there's a lot of concern around valuations in tech specifically. We've seen a huge amount of money flow into the tech sector in both private and public markets. How do you think about valuation right now?
Well, actually, yeah, they are very high. This is justified by the capex cycle that's going on in this sector. It's a wider issue. We think that the world is entering into a phase of low growth because the growth going forward will be less optimized. For the last 40 years, the down path in interest rates and globalization have allowed companies to optimize a lot of things. That's generating a lot of earnings growth. And going forward, the construction of resilience rather than the construction of efficiency will probably force companies to operate with higher capital buffers, to operate with higher levels of inventories, even strategic inventories, to cope with higher costs of production because they will produce closer to the consumer, higher cost of insurance as well. So lower growth, and in that context, we need to be careful about valuations. This resilience will be financed in two ways. One, by massive fiscal expansion, and so we think that long-term interest rates are probably too low for that reason. So it means a lot also for multiple expansion in its way to explain generation of performance on the private equity side, for example, or on anything related to equity, and on the other side, by a massive capex cycle. And if we listen to what somebody like Warren Buffett says, when there is a lot of capex in a sector, like the AI sector, for example, there is a big risk of misallocation of capital.
Yeah.
So you need to be extremely disciplined in the way you select your investments. On our side, we've chosen to play the AI theme indirectly because it's also a theme which is linked to our expertise in energy transition. So by investing in companies that are involved on the optimization of the grid, for example, which is something which is essential to energy transition, those companies are also involved in the installation and setting up and design of data centers, for example. And it's a play which is much cheaper, but also benefits from this mega trend.
Why do you think that it's underappreciated or so much cheaper? Because it seems pretty known that the energy piece is one of the key bottlenecks, one of the key barriers at this point, that there's simply not enough energy to power all of the AI build out, the data centers that are in production right now.
Well, it's cheaper because it's more granular. I mean, it's a sector, this sector of the, let's say, optimization of the grid, which again, I mean, there will be no successful energy transition without electrifying the end user, and to electrify the end user, you need an efficient grid. So, but this sector is made of thousands of players, extremely fragmented. So you need to have your boots on the ground. It's not like AI where you have a limited number of hyperscalers or very large firms, and on the top of that, the sectors are deemed a little bit more boring. I mean, for example, when you invest in companies doing maintenance of power cables.
Yeah. Not the sexiest of headlines.
Exactly, but you can enter at cheap levels, and when you play it well, those companies are also involved in the construction of data centers and benefit from this megatrend. So that's the choice we've made.
To what extent do you think nuclear is going to emerge as one of the key energy solutions to the AI energy need?
Well, it is at least a temporary, necessary solution. I mean, right now, AI consume about 2% of the electricity produced in the world, but in some countries, in some spots, like for example, I think in Virginia, it's 25% of the electricity production. Also in Ireland, close to 20%. So there are sources of stress, and of course, nuclear power with smaller reactors is probably the solution, at least for the foreseeable future. To cope with this. Yeah.
Let me ask you about private equity. You invest in private equity among other asset classes. Clearly, private equity has gone through a difficult period. We're seeing funds sitting on tens of thousands of unsold companies here. We're now poised for a Federal Reserve that's going to continue cutting interest rates. That's the market view anyway. To what extent is that going to ease the pressure, ease the situation for private equity, open the window for some deal making to get some of these deals over the line and exit?
So we think that the way to invest in private equity will change slightly going forward. Private equity is an industry that started probably in the 70s. The interest rates started to go down early 80s. So the industry has benefited from this whole cycle of seeing interest rates at 20% in 1982 to 0% in 2022. So over this for 40-year cycle, and I think that the model of, and I'm schematizing, but buying an asset-light company and putting a lot of leverage, benefiting from this lower interest rate cycle to have a multiple expansion and refinance your debt at cheaper price, will not be explaining most of the performance of private equity in the next decades. What will count is investing in more asset-heavy companies, and even in tech. Look at tech. I mean, companies like Microsoft, etc., are more asset-heavy than they were before, right? So more asset-heavy with a bigger impact on the capex plans, and so only the best companies, the best management teams are doing the right capex. So putting the right plant at the right place at the right time is not something which is easy. And so operating with more asset-heavy companies will probably change the value creation and pivot it towards making this company more efficient, increasing the margins instead of benefiting from multiple expansion and build up through M&A. So
that would mark a pretty significant shift in sort of business model or strategy when it comes to private equity. What does that mean for the returns profile of private equity?
Well, yes and no. I mean, of course, on average, it will change. It will introduce more dispersion probably between the funds because it will be less easy. But if you take the top quartile, the top performers, I don't think it will change their way of operating. I mean, that's the way the best have always operated. But if you look at what we've been doing at TKO since the beginning of our existence, is choosing themes, investment themes. Again, we are convinced that the world is entering into a period of lower growth. It's about finding the high growth pockets. Those high growth pockets, we are convinced, are all linked to the solution providers of the resilience. So aerospace and defense, energy transition, cybersecurity, regenerative agriculture are all sectors where the players are helping other companies to become more resilient. And we see that those sectors, despite the fact that growth should slow, are accelerating. If I take energy transition, for example, this sector has been very European historically, and it's normal because the regulation has been much tougher in Europe than anywhere else in the world with regards to climate action. But now all those companies are developing everywhere in the world. From a European base, and that provides a lot of growth. So finding those high growth pockets in a low growth world is probably something that the private equity industry will need to do much more. And so we believe a lot in the model of being specialists, partnering with corporates of the sector, developing a very strong expertise to be boots on the ground and highly selective is the way we've chosen to navigate this cycle.
How do you navigate the U.S.-China relationship? You mentioned a few sectors that are very geopolitically sensitive, defense and aerospace, obviously one of them. Yes. But how do you factor that into your decision making? Well,
for sure, it's going to be a headwind to earnings expansion. Because if you make too much business with one, you will probably not be able to make as much business with the other. So for obvious reasons, it's probably going to be an obstacle there. The decoupling should continue to operate, to accelerate. Of course, the U.S. will remain the largest market by far, the deepest capital market. So we need to be there, but we need to be there by being innovative, not by doing the same thing as the others have been doing for years and years. Right? There is no added value there. But in Asia, we also need to be there. We need to invest locally. It's the beginning of private markets in Asia, if I exclude real estate. There are a lot of interesting things happening in Asia with different jurisdictions, different regimes. But if you take this continent, there will be 5 billion people living on this continent in year 2100. If you take a cycle around Hong Kong of 5 hours flight, as our colleagues of GAFCAL often say, you've got 69 of the top 100 cities in this cycle, and you've got more people in the cycle than outside of the cycle, so you have to be there. Right? There will be a lot of value created in this region, and so that's why we are partnering with one of our local partners, launching Asian funds in private equity and private credit.
Fascinating to think about how much is going on in the region when you put it like that. Just lastly, coming back to the quote that you brought to us from Warren Buffett, and this whole idea that not everybody who's spending big on CapEx is going to emerge a winner here, and we're looking at billions and billions being spent on build out around AI, around tech. How do you go about determining the winners versus the losers here?
It's very difficult, and that's why we are very prudent in investing there. I mean, $500 billion probably dollars of capex for next year in this area, growing at 20% CAGR, so 800 billion, i.e., kind of the U.S. defense budget equivalent for private companies in 3 years. That's absolutely massive. If you look at the way the market is now splitting the sector, so you've got the AI infrastructure, so NVIDIA, etc. You've got the hyperscalers. of course, valuations have moved a lot in those sectors. But if you take the solution providers, so software providers, for example, and the end users, they've not necessarily benefited so far from this boom. So the market is acknowledging that there is a capex boom. There is a lot of calculation capacity being built, but have not identified the winners yet with regards to who will be the best solution provider and who will be the best end user for that. So it's still time to make your bets. Absolutely.
Thomas, thank you for the conversation. Appreciate you stepping in. Thomas Friedberger, Deputy CEO of Co-CIO Capital.